Vancouver real estate is an uncharted territory. Developers are not only losing projects, some are even losing their own personal mansions to foreclosure. For owners of large development companies to have their own homes seized by the courts is almost unheard of, and it just shows how serious the downturn has become. My name is Shahrad Sardari, a local realtor here in Metro Vancouver, and in this video, I'll break down what led to this moment, how major projects are collapsing, and why this story matters for the future of housing in our city. One of the developers at the center of this story is Thin Properties. The company had several large projects across Metro Vancouver, but what makes it stand out is that its owner is one of the ones who recently lost his own mansion in foreclosure. Thin Properties was considered a mid-sized developer in Metro Vancouver. They were not as big as the largest players, but they had several high-rise projects under their name. In Surrey, their District Northwest project fell into foreclosure. In Burnaby, their Metrotown Tower ran into problems. In Richmond, Menorah Square failed, and in Burnaby again, Eclipse Brentwood ended up in court. Now, Eclipse Brentwood is very important because it was almost 95% complete when KingSett, a lender from Toronto, applied for a creditor protection in January of 2025. In April, the court approved the process to sell the remaining unsold units, and by July, the court extended protection and construction resumed. The court-appointed monitor confirmed that completion is now targeted for December of 2025 and that existing purchase agreements remain in force. So buyers are still expected to get their homes, but the fact that a nearly finished tower had to go under court protection shows how fragile these projects are when sales slow down and debt piles up. The most striking part of this story isn't just the towers, it's what happened to the owner's personal properties. Daljit Thind, the head of Thin Properties, saw his own mansions pulled into foreclosure. One was a large investment property at 1542 West 28th Avenue. This was a 6,500 square foot home valued by BC Assessment at $7.75 million. In late 2024, Thind and his wife signed what is called a forbearance agreement with the lender. That agreement was supposed to delay foreclosure if they cooperated with listing and showing the home. Instead, the court filings showed the opposite. The Thinds were accused of blocking realtors from accessing the home, making showings difficult, and even extending the tenancy illegally. They reportedly took 20 months of rent upfront, which went against the lender's conditions. Because of those actions, the lender pressed ahead. On April 3, 2025, the Supreme Court granted what is called an order nisi. That set the debt at over $17 million, with interest adding up daily. The Thinds were given until June 16, 2025 to pay it back and stop the foreclosure. They failed to do so. The home was listed with offers coming between $6 to $6.6 million. But one buyer pulled out during the cooling off period, and by September, the asking price had been dropped to $6,398,000, far below its assessment value. The second mansion was the family's primary residence at 3138 West 51st Avenue. This was a massive 8,000 square foot home on more than 2 acres of land. It was assessed at $14.5 million and it was listed June of 2025, and by September, the court approved the sale at $13.6 million. It is extremely rare for personal homes to be caught like this. Developers usually protect their mansions and personal wealth through corporate structures. The fact that both homes ended up in foreclosure shows just how far over-leveraged the company had become. To understand how these homes were sold, you need to know how foreclosures work in BC. When a borrower defaults, the lender goes to court. The judge can issue an order nisi, which gives the borrower a chance to redeem the property by paying off the debt. If they fail, the court can then authorize a sale. Once the court approves the sale process, the property is still marketed, buyers can come in, view it, and prepare offers. These offers must be cash, subject-free offers, which means financing is already in place and there are no conditions. On the hearing date, all offers are submitted in sealed envelopes. The judge opens them in court and selects the highest offer. If the first accepted buyer has already made a deal, others can still outbid them on court day. This makes foreclosure sales a bit like an auction. In theory, that competition can push prices higher. In practice, luxury properties under foreclosure often sell below assessment because demand is thin, and that is exactly what happened here. At the same time, the pre-sale condo market across Metro Vancouver is failing. A pre-sale is when you buy a unit before it's built. Developers rely on those early sales to prove demand to the bank. Most lenders will not release construction financing until at least 70% of the units are sold. That 70% is not a suggestion. It is the make or break number. Without it, the project cannot move forward. According to recent data, more than 60% of all pre-sales in Metro Vancouver are below that threshold. That means thousands of units cannot be built until more sales happen. And right now, buyers are hesitant. This is not just about numbers on a spreadsheet. When pre-sales stall, developers cannot pay contractors, construction jobs disappears, Buyers who put down deposits are stuck waiting, and projects that were supposed to deliver homes simply never get built. The Urban Development Institute has reported that pre-sales for concrete high-rise towers are down by more than 50% compared to last year. That kind of decline is unprecedented in modern Vancouver history. It is not a slowdown, it is a collapse of the development pipeline. Even the largest developers are feeling the strain. In the River District, a master plan community in South Vancouver, West Group cancelled a project called Ardea. This was supposed to be a luxury waterfront building with more than 200 condos and townhomes. Deposits were collected, but the project was scrapped in 2025. West Group said construction costs were too high and the project was no longer viable at planned pricing. Even though they had purchased the land years ago at lower cost, the math still did not work. Instead of forcing through an unprofitable luxury tower, they refunded deposits and shifted focus to more stable projects, including family-oriented housing. West Group remains financially strong and continues to build other parts of the River District. But the cancellation of Ardea shows that even major developers with very deep pockets cannot make every project work in today's market. West Group still has over 2,000 homes under construction in the River District, so this isn't the company's total collapse. It is the luxury segment that has become way too risky. This downturn has already hit workers across BC. In July of 2025, more than 7,600 construction jobs were lost in the province. That represents tradespeople, subcontractors, site laborers, and many others. Construction is about 10% of our provincial economy. When sites shut down, the effect spreads. Suppliers sell fewer materials, trucking companies deliver fewer loads, engineers and architects and planners see contracts cancelled. These are not temporary blips. If developers cannot sell pre-sales, they cannot start new projects, and that means fewer jobs not just now, but also years into the future. The provincial government is also feeling the effect. BC relies heavily on property transfer taxes, which is paid every time a home changes hands. That tax brings in billions of dollars every year and funds hospitals, schools, and roads. With fewer sales, that revenue has collapsed. The province is now projecting a shortfall of $2.2 billion from that tax alone. That is money that will not be available for public services. When budgets shrink, governments may face hard choices: less money for hospitals and schools, or higher taxes elsewhere. Right now, it may feel like Vancouver has too many projects, developers are failing, pre-sales are stalling, and luxury towers are being cancelled. But the long-term risk is the opposite. If too many projects are cancelled today, the housing supply of tomorrow shrinks, and in 3 to 5 years, the city may not have enough new homes to meet demand. Vancouver real estate is going through one of the most dramatic corrections in decades. Developers like Thin Properties are losing towers, they are even losing personal mansions. Pre-sales are collapsing, projects are being cancelled, jobs are disappearing, and provincial revenues are shrinking. This is more than a cooling market, it is a system under strain, and while multi-million-dollar mansions grab headlines, the real story is how these failures today could shape housing for everyone in Metro Vancouver for years to come.